Sorry about that, guys. So I'm back right now. I wish I could do a split screen. I'm sure I could. I just don't know how to. But since I'm on the NASDAQ right now, you guys will be able to see the NASDAQ. I have a 15-minute up. It's coming in about 2 minutes. You could already see it came up to this area that we had already kind of blocked out right here. Knew that this was a key resistance to support area. Came up, rejected it, came down, but this low still didn't break this low, and we still had a high. So I'm not sure how to play it. I still have my little runner in here, see what's gonna happen with it, but let's see what happens. About a minute until I'm gonna go to US30 here. US30 is still looking pretty bullish, but it did have a breaker structure to the downside. Let me just go ahead and show you. This is on my other account. So this one's like my clear account now. But you can see it kind of broke the low right here. Just a little bit. 2 hours still pretty bullish though. Rejection right off the 50 EMA. Still looks like it can make its way up, but you have a rejection at this ILC. Inverted hammer. We could see a push down, but we don't know how it's going to play out. 30 seconds. Let's see what happens. Interested. This looks pretty bullish. NASDAQ kind of looks bullish. So, let's see. All right. Go time. 10 seconds. Let me get. I'm just interested to see how it's going to work out. I think it could push up if I'm just being honest for both of them, but still hasn't broken that low. Rejection right there. Oof, look at that. And them levels are on point, son. So yeah, they did a 0.25 rejection at the 20 EMA. I'm just interested to see what this really does right here. So could see it blow up or reject this again or make itself back up, make its way back up here or all the way up here. So let's see. So US30 is pretty indecisive right now too. I don't know what's happening. Let's see if I could get Jerome Powell up real quick. Oh, he's coming on at 11:30. So they're coming on at 11:30. Looks pretty fucking indecisive, so maybe it's just yeah, 2:30 Eastern. Show you guys what I'm seeing. 2:30 Eastern. Student. Nothing right now. Man, you talk about levels being on point though, huh? Rejection, rejection. I could see it coming up. That's why I was thinking, like, what would the negative catalyst be if we kind of know it's going to be a 0.25 basis hike, which it was. So I don't really know if that's a good thing or a bad thing. Like, I would kind of think it's a good thing if it's just the 0.25 and it's expected to be the last one. So US30 is basically doing the same thing right now. Looks pretty bullish though, right on top of these areas. You can see how it's right here on top of this zone. Key resistance to support. That's a good thing. 5-minute came down there, rejected that. Sure, it's on top of this. On the 1 minute here, using the support to continue up if I had to guess. But I don't know. I mean, That's why I wanted to stay away from this one today, because I didn't know what's really the market, how it's gonna take everything. Kind of coming down. Same thing. Looks like people are probably waiting for Powell to speak. You know, me as a scalper, I kind of look for the little things, and all I see is this holding up right here. This daily support level is holding up. And although this is holding up as well, you come down here. Let's go to the 1 minute. Oh, it's a nice rejection. If it holds up on the 1 minute 50 right here, go up. And I think it could, but it didn't break this high yet, so you can see it engulfing. So like me, I kind of want to buy because you're gonna have that bad of a buy, but I'm not gonna get greedy today. So you would have like a 40 pip stop loss, and I'm thinking you could kind of take this maybe all the way back up. But I think you could definitely take it to this area here. That's just a 1-to-1 risk to reward, but only reason I say that, go to the 15 minute. And it's kind of ugly, but see it get up here. And if Powell says something that they want to hear, like, oh, we're not, this is the last one, not going to do it anymore, this shit will fly. If, I'm assuming, I'm just guessing, but if he says this is, you know, a couple more planned or whatever, probably see this shit tank. So, I don't know. I don't have a buy-in. I'm just saying if I were to take a buy, um, I'd kind of be looking for this, but it's still rejecting. It still looks pretty bearish, so let me just take that out. 5 minute finish pretty bullish, but still that 1 minute look kind of crazy, huh? Has to break above here. Once it gets to the top of this purple line, then we could definitely see a continuation up happening, but levels. Looks like it could come down. We'll see if it breaks through this or just rejects, comes up. See what happens. What's up, dude?
Who said you can look that good outside of the house?
I'm on the YouTube.
Oh, no way.
Yeah.
No way.
Yeah.
Don't lie.
I'm serious.
Oh, I need to
What are you gonna make? Boom, right off the 20 EMA. Yeah, kind of.
But you're gonna have to have.
Alright, that's fine. I mean, I can see it pushing up right here, like I said, so look at that. That's giving me all the confirmations that it's gonna kind of push up. Still has to break through, but you see it engulfing both here and here. It could fall, it could push up, but I still have my selling, so 15 minutes, still pretty indecisive, but if it could get on top of here, it's when you're really in business. Still respecting that area. Bless you. Bless you. Still looks like it could get up there, so. What are you gonna put in it?
I put onions, squash, and spinach.
That sounds too healthy. Let's put spinach in mine. Oh, there it goes. Now it's starting to take off a little bit. So the 1 minute, 5 seconds, 3 seconds left. That looks pretty good, but still has to break through it. Dang, look at that. But it's giving everything about this is pretty bullish, right? A bunch of support was formed right here on this daily support level. So it kind of respected this zone again. Nice rejection off of it, back on top of the EMA. Starting to get the crossover now. But like I said, has to get through this, break this go high right here. Still not out of the woods yet, because it could come up here. I think it could even come up here. Either here it's gonna fall off, at least get a rejection, or here. Depending on what Powell says, I think we could see it do either of these things right here. And that's still about 21 minutes away, so it has a good amount of time to make it up right now. Or he says some good stuff and it just gets out of here. So you can basically it's still respecting the 50 EMA right here. And I mean, it technically did break the structure, breaking this low, breaking this little support area here. But I mean, depending on the news, like I said, I think it can make its way up still. So I think these EMAs are a little bit more important. But when like I enter a trade, like if I were to enter this trade, I didn't have any positions in it, I would enter this trade and I would basically try to see, you can see on the 5 minute here, you know what your little roadblocks are to get through, that you even need to get through if you're taking a buy at this situation. And like when you break it down to the 1 minute, you can see the 50 and the 20 EMA, they travel to each time frame, and each time frame could tell you something different. So the 1 minute will show you the crossover first. It doesn't mean it's always accurate because you got to kind of look at what price is doing, what market structure is. But you could see it kind of still respecting the zone. And even though it broke this high right here, this is only the 1 minute time frame. So it's not that important of a time frame. Once it starts breaking these highs, in particular this high, that's when it's really a break of structure to the upside and you expect a buy. But if you're trying to come in and scalp, thank you. You could see it kind of where the crossover is coming. Once you see this big rejection right here, this big rejection, big 1 minute candle engulfing basically the last hour and a half, longer. Once you see that, and then it comes back, retest. Now the 50 or the 20 EMA blue line is kind of being used as support now. Now you can see it kind of taking its way up from here. So it's still a downtrend. I think it could make its way up, maybe in the next 12 minutes, or just comes down. So that's why I'm not trading this, just because I'm not too sure, and it's already at the support level. So I wouldn't try to put in any sells right here, but it's just depending on what you're trying to risk. I still have my sell in at the top, and just kind of, it's a runner, so just kind of managing it. I'm just interested to see what price is going to do here. US30 is looking pretty bullish. Even right there, price is looking bullish on the 15-minute on NAS. Here, you can just see it already, that support level that's built right here. How it rejected it. Now it's starting to get engulfed here, engulfed this inverted hammer right off the 50 EMA. After it broke through this level, came back on top, already shown proven support. So I could see price like basically flying up from here for both of these, but it's just a matter of, you know, Jerome Powell speaking at 11:30. So, because even when you get down to, like I could see it here, go to the 5 minute. Well, there's not any ILCs right here, but this one here, but you can see it's already kind of getting on top, 15 seconds. Everything's pointing towards a bullish momentum, so everything's looking pretty bullish. And people talking about a recession, I'm not too sure. I was really a recession guy, but they said we were technically, even though we were technically weren't in one, it's kind of looked like everything's passed. So we'll see. Yeah, so I mean, who knows what it's gonna do?
Huh?
No, I'm on here. 11:30. Let's see it go live now. Hey,
Silas.
what are you doing? You stepped on you? Okay, I hear it.
Mama. 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 Mama.
Silas, you want goldfishies?
I'm on okay. US30. It's cracking, dude. Sorry, Liz. Right into the 50 EMA right here. Right back up to the 50 EMA, seen a rejection with 3 seconds left to go. Let's see what happens right here. Use this as support. Ooh, seen that? Use it as support. Continue up. If it breaks this high, for sure it's a break of structure to the upside. So we'll see right now. See, now the 5-minute 20 EMA is starting to cross over the 5-minute 50 EMA. Broken through this EMA. Now it's used that level as support here. Boom. Broken this high. I think this is all important for it to continue to go up, but from what he's saying they could raise rates again, so I think that could be a bearish catalyst that he's saying he could raise rates again, but we'll see. US30 is blowing up. Still pretty bullish, even the projection, but we'll see.
I would say
You want to take it off? You want me to take it off? You want me to take the shoe off? Yeah? Shoe left. Too fast. Give me 10. Again, the prototypes. 1, 2, 4, 5, 6, 7, 8. Did you go poo poo? Did you go poo poo? Gucci. Hey.
Square with the need for a more gradual.
I wouldn't. I just don't think that's. We don't. I think it's not an environment where we want to. And there are those who feel like.
Make yourself food or no?
I'm gonna make it right now.
Really good. I said I would take your son, but that means I have to stay there, right?
You got a what?
I'm gonna go to your mom.
You got a what?
Stay there.
But you said you got a what, my son?
Take your son.
So why you gotta say?
That's why I don't know.
Oh.
I mean, it would be good if I could go to the library.
Yeah.
Which is usually indicator.
So I guess the sluice will come out early next week, and I would just say it's broadly consistent with what you would expect. You've got lending conditions tight and getting a little tighter. You've got weak demand, and it gives a picture of pretty tight credit conditions in the economy. I think it's really hard to tease out how much of that is from this source or that source. But I think what matters is the overall picture is of tight and tightening lending conditions, and that's what this sluice will say.
Rachel.
Hi, Chair Powell. Rachel Siegel from the Washington Post. Thanks for taking our questions. Could you break down the reasons why inflation has fallen and what share of that credit you would give to factors that don't stem directly from rate hikes or that might be within your control at all, like easing supply chains and a drop in energy prices over the past year?
Yeah. So, interesting question. So, let me start by saying that the inflation surge that we saw in the pandemic resulted from a collision of elevated demand and constrained supply, both of which followed from the unprecedented features of the pandemic and the response from fiscal. And we've always expected that the disinflationary process would stem from both from the normalization of those broad pandemic-related supply and demand conditions and from restrictive monetary policy, which would help return the balance between supply and demand by restraining demand. And we think that's broadly what we're seeing. So to go break it down a little further, of course, headline inflation has come down sharply from elevated levels as energy and food prices have come down, mostly due to reversal of the effects from the war in Ukraine. And that's a good thing, and the public experiences that, as I mentioned earlier. For core inflation, I'd say there has been a role for both factors, both that I mentioned. Clearly, for goods, normalization of supply conditions is playing an important role, as is the beginning of the reversal of spending back into services and away from goods. Take autos as an example. The combination of an increase in sales and inventories, while vehicle inflation has decelerated, points to a substantial role for supply. But there's also a role for demand, as the loans and things like that are more expensive. So they're both working there. Housing services inflation now starts to move down. Clearly, higher rates have slowed the housing market. I would say monetary policy is working about as we expect, and we think it'll play an important role going forward, in particular in non-housing services, where really we think that's where the labor market will come in as a very, very important factor. So we think both of those sources of disinflation are playing an important role.
I see. And just to follow up, do you think more heavily on seeing an impact from rate hikes, or is there a more even split there too?
I think monetary policy is going to be important going forward, because we're sort of reaping now the benefits of the reversal of some of the very specific pandemic things. We're seeing that with goods in particular, with supply chains and shortages moving, and we're seeing. So I think going forward, monetary policy will be important, particularly in the sector, in the non-housing services sector.
Edward.
Thank you, Chair Powell. First, let me compliment your tie, the choice of tie. So thanks for taking our question. So the Beige Book, it said, input cost pressures remain elevated for services firms, but eased notably for manufacturing sector. Is that an indication that there's a wage inflation pressure? And how do you target and pressure on the wage inflation without pushing the economy into recession?
I think as it relates to goods, it's really an indication that supply chains and shortages are easing. And so what was the first part of it?
So wage inflation, like how do you target wage inflation without pushing an economy into a recession?
I don't think we're targeting wage inflation. I think what we're looking for is a broad cooling in labor market conditions, and that's what we're seeing. So wages have actually been gradually moving down. They're still at levels that would be consistent over a long period of time with 2% inflation. Nonetheless, we're making progress there, and by so many indicators, labor market demand is cooling. You can look at surveys by workers and businesses who see that. You can look at the quits rate normalizing. You can look at job openings coming down. You can look at just job creation in the establishment survey has, it's still at a high level, but it was at really an extraordinarily high level for most of the last 2 years. So you see cooling, particularly in private sector in the last in the last report. So I think we see that, and it's happening at a gradual pace. So that's actually not a bad thing in a sense, because if what we see is a labor market, very strong demand for labor, which is really the engine of the economy. People are getting hired, many people going back to work, getting wages, spending money, and that's really what's driving the economy. But that it's gradually slowing, it's gradually cooling. That's a good prescription for getting where we want to get.
But still, we see a push to raise minimum wage. We're seeing a lot of unions go on strike or threaten strike, and the common thing is they come out with agreements like big pay increases, like UPS, and we have the auto workers coming up. Are you concerned then about a trend of series of big unions, these contract pushing wage inflation then?
Not for us to comment on contract negotiations. Not our job, not our role. We monitor these things and we'll keep an eye on them. But really, that's something that's handled at that level. And not,
a large amount of people.
Victoria. Hi, Victoria Guido with Politico. I wanted to ask about the SEP, which suggests that you would cut rates as overall and core PCE get to around or under 3%. And so I'm wondering, is the level of inflation what's sort of important there as you think about getting to 2% and when you might start cutting rates, or is the speed at which inflation is falling also important?
I think you'd take both into account. I think you'd take everything into account when you start cutting rates. It would depend on the whole. On a wide range of things, and when people are writing down rate cuts next year, it just is a sense that inflation is coming down, and we're comfortable that it's coming down, and it's time to start cutting rates. I think, but I mean, there's a lot of uncertainty between what happens, in the next meeting cycle, let alone the next year, let alone the year after that. So it's hard to say exactly what happens there, what's motivating people.
So if it's sort of stubbornly in maybe the high twos, you wouldn't necessarily cut rates.
I'm not saying that at all. I'm not giving you any numerical guidance around that. I'm saying we'd be comfortable cutting rates when we're comfortable cutting rates, and that won't be this year, I don't think. It would be, many people wrote down rate cuts for next year. I think the median was several for next year, and that's just going to be a judgment that we have to make then, a full year from now, and it'll be about how confident we are that inflation is in fact coming down to our 2% goal.
A good part of Wall Street has become more confident that the Fed is going to be able to engineer a soft landing, and they've reduced their forecast for recession. And I'm wondering if the staff has changed its view on the likelihood of recession being likely, and if you personally have changed your view in terms of becoming more confident that you can achieve a soft landing.
So it has been my view consistently that we do have a shot, and my base case is that we will be able to achieve inflation moving back down to our target without the kind of really significant downturn that results in high levels of job losses that we've seen in some past instances, many past instances of tightening that look like ours. That's been my view. That's still my view, and I think that's sort of consistent with what I see today. So, but it's a long way from assured, and we have a lot left to go to see that happen. So the staff now has a noticeable slowdown in growth starting later this year in the forecast, but given the resilience of the economy recently, they are no longer forecasting a recession. I just want to note that that our staff produces its own forecast, which is independent of the forecast that we, as FOMC participants, produce. Having an independent staff forecast, as well as the individual participant forecast, is really a strength of our process. There's just a lot of, I think, constructive diversity of opinion that helps us make, informs our deliberations, helps us make, I hope, better decisions.
And is the reason for optimism that inflation has come down and you still have a strong labor market? I mean, does that add to the optimism?
I wouldn't use the term optimism about this yet. I would say, though, that there's a pathway, and yes, that's a good way to think about it. We've seen so far the beginnings of disinflation without any real costs in the labor market, and that's a really good thing. I would just also say the historical records suggest that there's very likely to be some softening in labor market conditions. And consistent with having a soft landing, you would have some softening in labor market conditions, and that's still likely as we go forward with this process. But it's a good thing to date that we haven't really seen that. We've seen softening through not through unemployment, not through higher unemployment. We've seen softening through job openings coming down part of the way back to more normal levels. The quits rate, so people are not quitting as much. We've seen participation, people coming in, and so labor supply has improved, which has lowered the temperature in the labor market, which was quite overheated, going back a year or so. So we're seeing that kind of cooling, and that's very healthy, and we hope it continues.
Thank you, Mr. Chairman. Jeff Cox from CNBC.com. You and other Fed officials in the past have suggested that you don't need to keep hiking until inflation hits 2%, that as long as you see continued progress. So I'm wondering, how close do you need to get with the inflation numbers coming down? How many months of data do you need to see that will give you sufficient confidence? And how far does this fight need to go before you're willing to kind of declare victory on it?
So the idea that we would keep hiking until inflation gets to 2%, it would be a prescription of going way past the target. That's clearly not the appropriate way to think about it. So. In effect, if you look at our forecasts, the median participant, and again, these are forecasting out years, so take them with a grain of salt. But people are cutting rates next year because the federal funds rate is at a restrictive level now. So if we see inflation coming down credibly, sustainably, then we don't need to be at a restrictive level anymore. We can move back to a neutral level, and then below a neutral level at a certain point. I think we of course would be very careful about that. We'd really want to be sure that inflation is coming down in a sustainable level. And it's hard to make. I'm not going to try to make a numerical assessment of when and where that would be, but that's the way I would think about it. Is you'd stop raising long before you got to 2% inflation, and you'd start cutting before you got to 2% inflation too, because we don't see ourselves getting to 2% inflation until all the way back to 2 until 2025 or so. So.
Jennifer.
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. It's been over 4 months since a handful of regional banks, including Silicon Valley Bank, failed. When you look at credit conditions now, given Bank of California's acquisition of PacWest, does this acquisition suggest the full impact has not been felt, or are you comfortable saying that we've seen most of the ripple effects that may have occurred at this point, and how into your outlook for policy?
So I don't want to comment on any particular merger proposal, but I will say things have settled down for sure out there. Deposit flows have stabilized. Capital and liquidity remain strong. Aggregate bank lending was stable quarter over quarter and is up significantly year over year. Banking sector profits generally are coming in strong this quarter. And overall, the banking system remains strong and resilient. Of course, we're still watching the situation carefully and monitoring conditions in the banking sector. In terms of the the actual effect on, if you think of a particular set of banks that were affected because of their size and business model and things like that, that were more affected by the turmoil in March than others, it's very hard, as I mentioned, it's very hard to sort of tease out the effects on this very large economy of ours from them tightening. They may be tightening a little bit more, probably are, than other banks. The SLOOS has been telling us for more than a year that banking conditions are tightening. That process is ongoing, and that will restrain economic growth. So I think we have to take a step back from. I can't separate those anymore. I think basically we're just looking at the overall picture, which is one of tightening credit conditions, and that's going to restrain economic activity. It is a restraining economic activity. So that's how I would look at it.
And how is that informing your outlook for setting policy?
So I think that is an expected result of tightening interest rate policy, is that bank credit conditions bank lending conditions would tighten as well. And so the question is it more effective this time because of what happened in May? I just don't think we know that. I think we're looking at the current data in GDP, and we're seeing strong spending, we're seeing a strong economy, and it's made us confident that we can go ahead and raise interest rates now for the third time since the March events. It seems like the economy is weathering this well, but of course we're watching it carefully and expect to continue to do that.
Hi, Chair Powell. Thanks for taking our questions. Megan Casella with Barron's. I wondered on wages if you were at all concerned about any inflationary impact of wages now outpacing inflation, which is likely contributing to the boost in consumer sentiment and the continued strength of the consumer that we've been seeing.
Well, wages in excess of inflation means real wages are positive. Again, that's a great thing. Of course, we want that. We want people to have real wages, but we want wages to be going up at a level that's consistent with 2% inflation over time. As I mentioned, nominal wages have been coming down gradually, and that's what we want to see. We expect to see more of that. That's just more of what's consistent over a longer period of time. We don't really think that wages were an important cause of inflation in the first year or so of the outbreak, but I would say that wages are probably an important issue going forward. Labor market conditions broadly are going to be an important part of getting inflation back down, and that's why we think we need some further softening in labor market conditions.
This goes sort of to the balance of risks question, but you mentioned at the start how you're keeping an eye on consumer activity and whether there might be some sort of a rebound there. And I'm curious what the Fed's explanation would be to families if further interest rate hikes start to hit the labor market, start to drive that sentiment back down. What's the message there of why you continue to keep rates elevated or to raise?
Well, we have a job assigned to us by Congress to get inflation under control. And we think the single most important thing we can do to benefit those very families, especially families at the lower end of the income spectrum, is to get inflation sustainably under control and restore price stability. We think that is the most important thing we can do now, and we're determined to do that. And I would just point out that the people who are the most hurt by inflation right away are people who are on a low fixed income, who, when you're talking about travel, or transportation costs, heating costs, clothing, food, things like that. Those, if you're just making it through each month on your paycheck and prices go up, you're in trouble right away. Even middle class people have some resources and can absorb inflation. People in the lower end of the income spectrum have a harder time doing that. So we need to get this done, and the record is clear that if we take too long or if we don't succeed, that the pain will only be greater. So that's how I would explain what we're doing.
Thank you, Chair Powell. Simon Rabinovich with The Economist. You had said last month that this meeting this week was going to be a live one. In the event, the market had assigned a roughly 99% probability to the rate move that you announced today. The decision was, of course, unanimous, and the statement was basically unchanged from last month. So may I ask, to what extent was the meeting actually a live one? Was there ever any doubt over the past 2 days about what the decision was actually going to be?
Well, I mean, Was there doubt? Look, I would say there's a range of views on the committee, and when you see the minutes in 3 weeks, you'll see that. There's a range of views about what we should do at this meeting and what we should do at the next meeting, and it's a process that we go through. Many times when we go into a meeting, the decision is not, fundamentally in doubt. Nonetheless, we have the meeting, and some meetings are less uncertain than others, and I'll just leave it at that.
Evan Reiser, Market News International. Thank you, Chair Powell. Financial conditions have been loosening at a fairly steady clip in recent weeks, the dollar, the stock market, et cetera. What does that mean for the Fed and being sure that inflation will come down to target?
So we monitor, of course, financial conditions, broad financial conditions. You're right, it's the dollar and equities, we're, of course, very focused on rates and our own policy. We're going to use our policy tools to working through financial conditions to get inflation under control. The implication is, we will do what it takes to get inflation down. And in principle, that could mean that if financial conditions get looser, we have to do more. But what tends to happen, though, is financial conditions get in and out of alignment with what we're doing, and ultimately, over time, we get where we need to go.
If I could also ask about the SEP from June that showed rate cuts. Do you expect the Fed to cut nominal rates next year while also continuing QT?
So that could happen. The question is, is that consistent with? So if you think about both of them as normalization, imagine it's a world where things are okay, and it's time to bring rates down from what are restrictive levels to more normal levels. Normalization in the case of the balance sheet would be to reduce QT. So. To continue it, you depending on where you are in the cycle. So there are two independent things, and really the active tool of monetary policy is rates. But you can imagine circumstances in which it would be appropriate to have them working in what might be seen to be just different ways, but that wouldn't be the case.
Let's go to Kyle.
Thanks, Chair Powell. Kyle Campbell with American Banker. I have a question about the discount window. I'm wondering if since the bank failures of the spring, if you've seen signs that banks have taken more steps to be proactive in assuring that they're ready to use that facility if they need to. And if you have any sort of thoughts on whether policies might be appropriate for making sure that banks sort of test regularly to show that they are prepared to use it. Thanks.
So that's a very important thing, yes, and yes to both sides of that. Yes, banks are now working to see that they are ready to use the discount window, and we are strongly encouraging them to do that, banks broadly. We did find, as you know, during the events of March, and that that it's a little clunkier. It can be a little clunkier and not as quick as it needs to be sometimes. So why not be in a situation where you're just much more ready in case you need to access the discount window?
Let's go to Mark Hamrick.
Mr. Chairman, Mark Hamrick with Bankrate. You've talked in the past about getting the housing market back into better balance, excuse me, and also that the market might have bottomed. Where do you see that situation and balance, or lack thereof, right now, particularly with the constrained inventory of existing homes that might otherwise be coming onto market at a time when existing homeowners are reluctant to move? And of course, all of that happening with the 30-year fixed-rate mortgage still around 7% on the heels of Fed tightening, and with what you're talking about, tightening industry lending standards. Are we getting closer to balance or farther away? What's your sense?
I think we've got a ways to go to get back to balance, really for the reasons that you talked about. With existing homes, there are many people who have low-rate mortgages, and whereas they might want to sell in a normal situation, they're not going to because they have so much value in their mortgage, which means that supply of existing homes is really, really tight, which is keeping prices up. On the other hand, there's a lot of supply coming online now. And there are people coming in. A lot of the buyers are first-time buyers coming in, buying it with these relatively elevated mortgage rates. But I think this will take some time to work through. Hopefully, more supply comes online, and we work through it. We're still living through the aftermath of the pandemic.
We'll go to Nancy for the last question.
Hi, Chair Powell. Nancy Marshall-Genzer with Marketplace. Russia has pulled out of an agreement allowing shipments of grain, safe passage through the Black Sea, and alternative routes at this point could be closed off. Just wondering, how could that contribute to higher food prices and inflation generally, and how closely are you watching that?
We are watching it, of course, very closely. And you're right, the withdrawal from the Black Sea Grain Initiative does raise concerns about global food security, particularly for poorer countries that import a large share of their food. Grain prices did go up on this news, but they remain well below their peaks of last spring. And the moves that we've seen so far, I would say, are not expected to make a significant contribution to U.S. inflation. Of course, we will be watching that situation carefully.
So you don't think it would have a big effect on Fed policy at this point?
You wouldn't say so looking at what we know now.
Thank you.
Thanks very much.
Thank you.